When I was telling you about financial statements, there are three financial statements: the balance sheet, the income statement, and the statement of cash flow. So this is the statement of cash flow. There are two general types of statement of cash flow: indirect and direct. So most companies use the indirect method, which consists of cash flow from operating activities, cash flow from investing activities, and financing activities. This is the easiest statement to double check to know if it's correct, because I start with the beginning cash. I take into account all of the items going through the statement of cash flow. If I'm recording them correctly in the statement of cash flow, my beginning cash plus my changes in cash flow will equal my ending cash. I can check these from the cash amounts on the balance sheet. This is how I create a statement of cash flow using the indirect method. And like I said, most companies use the indirect method. I start with a net income, and a cash flow, statement of cash flow is as of a particular period in time. And the cash agrees with your balance sheet. So I start with a net income. I add depreciation. Why? Because depreciation does not result from cash flow. So I add it back to my income statement. Then I add my current assets that decrease. I add my current liabilities that increase. Those are my current items, my current activities, my current assets, and my current liabilities. And then I subtract my current assets that increase and subtract current liabilities that decrease. After this, then I adjust for my long-term activities. So all of what you have seen here, the depreciation and adjustment for current assets and current liabilities, results in the cash flow from operations. After I've completed my operating portion of my statement of cash flow, then I go into the long-term section. So investing is deducting for the increase in long-term assets, or I add for a decrease in long-term assets. Financing is the result of my long-term liabilities or equity. So financing, I add for an increase in long-term liabilities, deduct for a decrease in long-term liabilities. I add for an increase in equity, and I deduct for dividends paid, which results from retained earnings. So investing and financing, those together, along with the operations part of the statement of cash flow, give me the total impact of cash flow for the time period. I add those to the beginning cash balance, and I know if I'm right in the way I created my statement of cash flow, if all of that equals my ending cash balance. This is the exciting part of everything that you're learning. This is the statement of cash flow in action. I get my net income from the journal entries that I showed you in earlier slides. The net income is $110. There was no depreciation. I didn't give you an example of depreciation, but if I did, it's a non-cash flow item, so I would add it back. I get total cash flows from operations. I deduct any increase in accounts receivable. Why? Because if my revenue goes up, my accounts receivable goes up, I'm not actually collecting that money yet. I add back my increase in accounts payable because my accounts payable goes up. That means I'm not paying as much of my expenses. So I add that number back. That gives me a total operating cash flow of $100. I didn't reflect any investing activities as far as examples, but I did provide you with an example of financing activities. The owner put $500 towards the equity of the business, put $500 into the business, which increases the equity. So when I add all of these activities together, the operating cash flow and the increase in equity, that gives me $600. I add that to the cash at the beginning of the year, which was $0. We're starting off this business, right? And that gives me the correct ending cash balance. So I know that this statement of cash flow is correct. I have my net income. I adjust for my operating cash flow activities. I reflect my investing and financing activities. I get a total. I add to the cash at the beginning of the year. It gives me the correct cash balance at the end of the year. This is how a statement of cash flow works. We have had a chance to look at the components of the financial statements, the balance sheet, the income statement, and the statement of cash flow. So we know it's important to watch our numbers when we're running a business and then make adjustments when you see trends, positive and negative, right? If we see positive, we want to maybe understand what's creating that positive trend and do more of that. If we see a negative trend, we want to try and make adjustments and then anticipate if I want to see revenue and profitability in the future, I can use my financial statements to strive to make that happen. So take some time to make sure you understand your financial statements, your balance sheet, your income statement, and your statement of cash flow, so you can use them to effectively run your business.